world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we welcome thinker, writer, and former Fintech founder Lex Sokolin back on the show. Lex started a roboadvisor way back in 2009, which was eventually sold to AdvisorEngine. As a result of that experience and the strategy and advisory work he's done since, Lex has unique insight into the evolution of the digital investment space, one of the fastest moving areas of fintech today. If you enjoyed today's episode, please subscribe on iTunes or your podcast platform of choice and leave us a review. Thank you very much for joining us today. Please welcome Lex Sokolin. Lex Sokolin, welcome to Rebank.
Thanks for having me back.
My pleasure. There were some interesting topics that you've covered recently in your newsletter, and I think they kind of overlap with some of your own personal experience, which has been in kind of the digital investments space. Maybe for context, quick intro, those who haven't caught up with you in a while or listened to those past episodes, maybe discussing that kind of earlier digital investments piece and then the work you do now.
Absolutely. Robo-advice, which is the media term for digital wealth management or digital investment management, has a very special place in my heart, which is covered in startup scar tissue. It's where I really went on the entrepreneurial journey, and it all really started for me. I'm being dramatic. It all really started for me with the collapse of Lehman Brothers, which is true. It's true. I was in the strategy group of a fairly large private wealth business at Lehman, and the goal of that business was to serve wealthy people with complex products and charge a lot of money for it. And as an analyst, I ran a lot of Excel files figuring out how to make that business more profitable for the strategy group. And one of those projects I still remember was called the Custody Fee Initiative. Now, it's custody. All of that is in quotation marks on a piece of paper that's also in quotation marks, because there was no custody fee. It was just, how do we fire clients that we don't make money on? Right. So we had, I think, something like 40,000 households that were our clients. A good client was someone who had 5 million or more with us, and so we wanted to just fire half of that customer base by charging a minimum fee. So I remember running the analysis at the age of 23 that said $5,000 is what we should charge every single person for the privilege of having a Lehman Brothers private wealth account. And so did UBS, and so did Goldman Sachs, and so did Morgan Stanley. Now, my observation coming out of that a few years later, having been a little bit techie along the way, is that really that service is humans talking to humans and then using software to make analysis in order to talk to humans again to persuade them of decisions around investment product. So you could theoretically just cut that out. You could say, well, the client goes direct to the software. And in 2019, this is so painfully obvious, it seems, to say it is to just like list the alphabet. But in 2009, it wasn't this way. And the assumption was that small accounts are bad. You want to get rid of them. They're not profitable. You don't want people to even know how much they've invested with you, because they'll get nervous and sell. So an informed client, real-time reporting is a bad thing because your clients will just leave. So you want to give them quarterly reports and kind of keep the information to yourself. So there's really quite a pivot to think about democratizing access to this product and to use tech in order to intermediate it. And that's what led me to Started a company called Nest Egg Wealth in late 2009. Other companies in that cohort would be, the successful ones would be Betterment, Wealthfront, a little bit later, 2012, Personal Capital, 2010, 2011, a company that was, Personal Capital is probably the most similar outcome to what I started building. And that took us on a journey that, shifted the model quite a bit, and I'm happy to talk about what it is now, but that shifted the model quite a bit and highlighted what happens to B2C fintech companies. And that's very generalizable. And I've been able to draw on that experience to, go sideways into other industries and other technologies.
So that's excellent context to start us off. And maybe the most interesting entry point is SoFi's recent launch of a free ETF, right? Because that kind of takes us from this traditional model where you had, white glove wealth managers to now a completely digitized landscape. Free ETFs, like that's kind of a trend. Free share trading. We connected with Free Trade recently on the podcast. We kind of talked through everything that's going on there. Robinhood has obviously been a massive success in the U.S.
Hey now.
All right, would be interested in your views there. But okay, so you saw this SoFi news. What are your thoughts, and what's that an indication of?
I love the SoFi news for so many reasons. The first thing I love about it is, it's basically taking a brick and throwing it into a glass window, right? The messaging is this: active investment management is dying. Just look at flows. So all of the flows are going into passive investment management, right? So manufacturing indices and investing algorithmically. What is active investment management worth? It's worth nothing, right? So the outcome of where a lot of this stuff has gone is basically zero price compression on asset management product manufacturing. Fidelity launched, self-indexed mutual fund earlier in the year, also at a 0 basis point price. Now, that's not true for all investment management product. There's going to be high-end stuff that's difficult to replicate. That's going to be maybe 5% or 10% of your portfolio at 80 basis points. So 0 on your core being equities, and 80 basis points on a little portion in international developed value or something like that is going to blend out to 20, 15 basis points overall. So there's still value in delivering investment advice solutions holistically. But this one piece of product is free. And it sounds a lot like what happened to music. And it sounds a lot like what happened to retail distribution, right? What's the cost of music? It's nothing. What's the cost of video? Nothing. And it's very much the internet monopoly playbook to destroying a series of incumbents. So from that perspective, I think it's delicious news just because I enjoy creative destruction. There's another lens to look at it, which is SoFi is a digital lender. They make student loan. The core business of SoFi is to arbitrage the government. The government says, here's an MBA student. They've taken out $150,000 worth of debt because we are the government. Everyone pays an 8% rate. So we do not discriminate around how much different credit risks. SoFi says, well, that MBA student is going to pay it off most likely, so we're going to charge her 1.5%. So the moment you switch to SoFi, you save 6% on 100K. So you immediately get a check in your pocket. Great business concept, great arbitrage, makes sense. So they're a digital lender, and they're not. They didn't start out as a wealth management firm. They did not start out as an insurance company. They did not start out as a mortgage broker. And yet today they are all of these things. And that says, number one, that robo-advice technology is easy enough for anyone to roll out. It's 2019, so it's been commoditized. So Merrill Lynch and SoFi and Betterment can all have very similar stacks. And then number two is a story around venture-backed global brand champions. And it's sort of a mouthful, but the observation is in every single product category, whether it's payments or lending or investments or banking, you now have a global product champion for banking, somebody like Revolut, for wealth management, again, Betterment or Acorns, or for trading, it's Robinhood, for lending, it's going to be your SoFis. And they're massively venture-backed. I mean, they sit on a pile of money as tall as the Freedom Tower. So they need to figure out a way to make recurring, profitable customer revenue, and they need to do it across products. And so they can't just focus on their thing anymore. They've got to go sideways. And so no matter where these fintechs started in terms of their initial entry, the outcome everywhere includes the full suite of things. And of course, a core pillar of that is digital wealth management. So it's super satisfying to see, because this kind of, back in my mind in 2009, when nobody wanted these clients and they were seen as, the bane of profitability, for every single financial institution, full stop, of any kind that is tech first, they have a digital wealth management offering. And so this stuff is spectacular for the consumer.
Okay, so the one concern that I find myself continually coming back to is consumers are, based on experience in other types of apps, technologies, platforms. You mentioned music and video, TV video consumption before. Those are great, but that's entertainment, right? It's not like supporting you in building your financial net worth over time. Giving away free ETFs is different from providing the sort of guidance, advice, financial education that allows people to optimize for their long-term financial well-being. Are consumers misguided in expecting zero-cost passive funds, which aren't necessarily kind of tailored to their personal circumstances, or do we just kind of accept that tailored guidance N of one sort of stuff will be built in as kind of an add-on, a customer hook over time as the space gets more competitive and the data connectivity gets better?
I think that's a difficult question, because it goes to the heart of kind of the human animal. And I'd recommend an awesome book I just read recently called Elephant in the Brain. So everyone check out Elephant in the Brain, because what it tells you is humans are really good at creating stories and narratives to justify bad behavior. So if you think about, I'm like answering your question in the most roundabout way. So if you think about like acting onto the world, most people think, I perceive a situation, I reason about it, I create a course of action, and then I take the action. So what we actually do is we take the reverse action. We do the opposite thing of what we'd like to be doing. And that is, we perceive the situation, and immediately our mammalian reaction is to take some action. We already decide immediately where we're going. And then we spend the next hour, day, or week making up narratives in our brain subconsciously for what we did and persuading ourselves that that's the truth. And for evidence of this anecdotally, look at a journal that you might have had 10 years ago, and you'll see that your memories of how the narratives of what you did and why you made decisions is really 100% different from what you'll see the person at that time trying to say or do about it. Or if you've ever had a memory that keeps shifting about its details, an example of your brain creating narratives. And so the reason I bring this up is that human behavior about financial products generally is terrible. We make decisions about them not for the reasons we state, which is I want a safe retirement, or I want to provide for my family. It's for much more selfish, short-term, and irrational reasons, like my neighbor bought Bitcoin and now has a new car, and so I want a new car. Or this thing looks like fun, or my wealthy friends are doing it, so I should as well. So these social reasons and short-term reasons or gambling reasons drive a lot of that consumption. And so there's one way to build financial apps is to say, I'm just going to give everybody an opportunity to gamble. Free choice for everybody. And that's the same thing as like opening up a store and the only thing you serve is 100 different versions of Coke and burgers, right? Like, sure, you have choice, but they're all, from a financial perspective, unhealthy for you. But you have choice and it's free, right? So eat as much as you want. And thus my issue with Robinhood. But you can't, it's not Robinhood's fault. It's the fault of kind of how we're wired and why we do certain things. The other direction is instead of fixing a problem, doing preventative medicine. So preventative medicine is going to the dentist once a year at least, or it's going to your financial planner and doing a net worth assessment and a risk tolerance and mapping your goals over the next 50 years. And for most people, that experience is probably far worse than getting a cleaning. Because for most people, the answer is you don't have enough money, you're not going to retire, you won't get the house, stop having kids, right? Like that's not a great outcome. And so that's the difficulty in digital investing, where on the one hand, you're really tempted to just go the product approach and advertise pricing and it's a free-for-all and blah, blah, blah. And people can start treating that as information and engaging with it in a way that they did with other apps. But realistically, the right thing to do is asset allocation, it's financial planning, it's the emotional connection with a financial advisor who will make you make better decisions. It's how do you take somebody through a market downturn, which we haven't had in 11 years, and make them hold through difficult situations. And that is something that digital investing is only starting to really scratch the surface of, because our apps are still very much places where somebody makes unguided purchasing decisions off the shelf, and not automated personal financial assistants that just happen to fulfill financial product.
Okay, well, I think that's an excellent and very honest answer. At the end of the day, it's something of a conundrum, right? And I think you get to the core by kind of digging into the human nature. If you have the choice between buying a Coke and buying a dental appointment, I think most people would choose the Coke, right? I don't know. It kind of has something of that old psychology experiment around the marshmallows, right? So I don't know. Maybe we simply content ourselves by recognizing that those among us who are going to wait for the second marshmallow and therefore go on to go to better schools, get better educations, not go to prison, and all the rest, are the ones who are going to take the time to learn what they need to meet with a financial planner to support good long-term decisions. I mean, at the end of the day, we're talking about businesses who are responding to consumer demands, and if consumer demands are for free stock trading as opposed to $9.99 or $12.99 or your $5,000 flat fee at the incumbent wealth manager, well, okay, so someone's going to serve them. I don't know. Over time, I think it's inevitable that a bit more kind of guidance and handholding gets built in. I think it gets increasingly easy with technology, with data connectivity. I think one of the challenges is around the highly regulated nature of advice, and it's highly regulated for a reason. Traditionally, there's been a poor alignment of interest between advisors who are often paid commissions by the product manufacturers to kind of motivate the quote-unquote objective advice and guidance that they're giving to customers. So regulators are big on making sure that's managed properly. The result is it becomes so painful and costly to guide any clients through that process that both for the investment manager / provider and the customer, it's better to just kind of set that to one side and focus on kind of the self-directed free ETF, free share trading type stuff.
Yeah, let me react to a little bit of that. So, I want to moderate my point of view about free trading and say that I really appreciate and value the price compression impact of technology first solutions. So I think it is an absolute good that trading is trending towards free, because you can make money on other parts of that infrastructure. You can make money on margin, you can make money on cash sweep, which is something firms like Lehman and Goldman and UBS all did. They just had 8 different revenue sources in their wealth business, rather than, for Robinhood, the 2 revenue sources, and Robinhood's willing to take
which are what, the margin lending and the
margin lending and yes, the flow, the margin lending, and I think they also make money on their cash sweep. So if you have cash in your account. So again, if you Goldman does the same thing, they just get paid also much more on everything else. So the fact that a venture-backed brand champion is willing to take an 85% revenue haircut in order to grow the base is, I think, spectacular longer term, because from an economics perspective, you want to get rid of economic rents and make things more competitive. And then the second part of that is you're opening up markets to consumers who previously didn't have access. And that sounds, again, super boring today, but it is a real thing that you can, lower your account minimums and so on. Give you another example of just a little bit of a tactical example of why you need a 0 basis point ETF, or why you need no commission trading. So on Robinhood, you can trade stocks for free. In the advisor world, which, by the way, is at least a 3-4 trillion assets under management world for independent wealth managers, not the Merrills, but the independents of the world. So those guys all sit on 4 major custodians who actually hold the assets, and those custodians are Schwab, TD Ameritrade, Fidelity, and Pershing. And that's not their direct-to-consumer brokerage business. It's their institutional enterprise custody business on behalf of financial advisors, who then intermediate and provide advice to clients, but open accounts at those institutions. And that's about, that's a 3-4 trillion AUM chunk. So some tactics there. If you are at Schwab and you want to trade a Schwab ETF, you don't have to pay a transaction fee. That's not going to cost you $5. That's going to cost you 0. And you're probably going to have a very cheap ETF to boot, because Schwab makes it. Why? Here's the reason. So let's say there's a Schwab robo-advisor account, and in that account is $5,000, let's say $10,000 to make the math easy. So $10,000. Take that $10,000 and do an asset allocation for it. Let's say you have 10 asset classes, so 10 different ETFs in the portfolio. Equities, bonds, value, small cap, etc. Real estate, commodities, something reasonable. So you take that, and now you need to rebalance it because it drifts. Stocks go up, bonds go down, bonds go up, stocks go down. So let's say you rebalance it 4 times a year. I want to change my math. $5,000 portfolio, you rebalance 5 times a year, right? So 10 asset classes, 5 times a year. So that's going to be 50 trades, right? 50 trades. If you charge $10 for the 50 trades, that's $500. Now, $500 into $5,000 is going to be 10%. 10% of your portfolio in trading costs. It doesn't work. So the only way you can service a $5,000 portfolio and rebalance it and do the right thing is if trading is free, and the whole product offering supports that. So in a way, the fact that you're opening up this market and building solutions to serve this market manufactures the price collapse across the component services. And that's been extremely powerful. Unbelievably powerful. I don't think anybody in the seed in 2012 would have said, ETFs cost 0 and there are no commissions to trade them.
So I think this is actually an interesting pivot to a broader question, which is around the kind of evolution of the investments landscape. And now we're kind of looking at what we would maybe have otherwise, in simplistic terms, thought of as kind of robo-advisors versus incumbent investment managers. Clearly, some of the incumbents, specifically in the U.S., have kind of taken this more on the front foot, Schwab being a great example. How do you see that dynamic playing out? Everything from the wealth fronts and betterments and scalable capitals on one side to the incumbent kind of direct to consumer type investment managers to the traditional kind of white glove wealth managers. I mean, what does this industry evolution look like over the next few years?
For sure. So, on the one hand, you do have the brand champions that have remained independent. It will cost them $1.5 billion of venture capital to get to where they want to be, and so they're still on their journey, right? So SoFi's raised 1.5 or more. Betterment's personal capitals, they've raised a couple of $100 million, so they're not quite there. Break even for them is around the 20 billion mark. I think Betterment's at 15 or so. AUM, assets under management. So they really need to get to 50 or 100 billion to ever return enough to the venture investor to have been a good play. And that's why, I keep kind of saying at this point, there's only one way they can go. They can't really IPO because their economics aren't good enough, and they can't be bought because they're too expensive. So those are the brand champions, and I'll put them aside because the answer to those is the same as for the rest of the SoFis and the Revoluts, which is your play is to get 100 million customers and give them all the financial products. A low probability event, but potential there. So that leaves us with smaller providers or the B2B providers. So my company, Nest Egg, then AdvisorEngine, realized that the software to power this stuff is, in the short term at least, more valuable and monetizable than the customer acquisition play. And so many folks started, back in 2014 through now, started integrating with companies like Schwab and Fidelity NTD, who did the equivalent of open banking 5 years earlier, opened everything up and had APIs for money movement and investing and trading and account opening, all that stuff in structured APIs much, much earlier. So that's one direction, and that direction strengthens the incumbents. There's no other way to say it. It opens up the market and it creates some powerful fintech vendor companies. Envestnet is a multi-billion-dollar public company. Fiserv can get there. SS&C can get there. They're all large multi-billion public companies, but they are going to be a 10th or 100th the size of JP Morgan, and that's the limit. The other dimension is, I love the examples, like you said, scalable. Sure, that's BlackRock. Or you can say Nutmeg. Sure, that's Goldman Sachs. So they still retain their brand today, but end of the day, it's BlackRock.
It was Schroders before, right? Now it's Goldman Sachs.
It's a little, yes. Appetites change. Goldman's become super aggressive, right? So Goldman is building a fintech brand champion for Marcus. Marcus is a digital lender to compete with any other digital lender, lending out basically private equity and hedge fund balance sheet that Goldman manages. They also have a neobank in the UK, and then they have a whole bunch of robo advice pieces that So they've become super aggressive at going retail, which is bizarre to say that Goldman's going to be the leading retail fintech company.
Something else you wouldn't have expected in 2012, right?
Yeah, I can give you the number. All the fingers on all my hands are the number of times I've gotten kicked out of a Goldman meeting or a Morgan Stanley meeting or a UBS meeting trying to pitch them the retail consumer with automation in 2012. And that's the scar tissue around it, because you just learn that people are super resistant at certain points of time, and then the whole thing shifts. And today, we're definitely at a place where everything has shifted to survive. All the smart incumbents who see this, who see the price collapse, who see where the attention is going from consumers, understand that they need to be mobile first, they need to play in the attention economy and all the other sort of buzzword stuff that you would say to motivate really aggressive spending in the strategy.
All right, so I think we've hit on some really interesting points there in terms of the digital investment stuff. And if we kind of step back and to kind of wrap up this installment of our ongoing conversation, what else are you kind of most intrigued by at the moment? What other trends are you following most closely?
So I guess it's time for the tinfoil hat. The things that I'm really finding interesting I think it all comes down to your risk tolerance. So there's probably listeners on the podcast who are innovation executives at banks and are thinking about how do we deploy these tools to retain market share and to grow. There's probably entrepreneurs who are thinking about, how do I make my brick heavy enough to break through the glass of the industry. And so it really depends on your risk posture and what you're trying to accomplish to answer that question. It's really a strategic game. The thing that's exciting for me is I think there's a game between large finance and, they're incumbents versus the fintechs. There's a game within incumbents that is large incumbents versus small incumbents. The answer to that to me is clear, which is small incumbents get commoditized out into the long tail. They're going to rent software from more fast forward-thinking providers, but generally speaking, they're going to get commoditized out as open banking comes through. So then you have the large incumbents building out what we think of now as fintech, but will just really be JP Morgan or Goldman. And then that, you take it and you put it versus fintech. And again, for much of the fintech movement, the startups have been co-opted by corporate venture capital or by vendor management processes or accelerators. And so it's become this like outsourced research and development arm for the incumbents, but for these brand champions which have surged through and gotten a lot of consumers but need to figure out their economics. So you layer on top of that the tech firms. And the tech firms you have to split into sort of the American attention platforms, Google, Facebook, even Amazon to some extent as attention platforms. And then the Asian big tech firms, which are sort of AI everything together. And when you interact those with financial services, you're starting to get some more existential outcomes. But I think we already see the answer there too, which is for the large tech firms, most of them just want to pimp out their ecosystem with financial services features. So they don't need to manufacture the thing. They'll just take the best version of banking and the best version of lending through APIs and shove it inside the thing that they actually do already. And I think that's true for the Asian fintechs to some extent as well, especially given sort of the expansion internationally. So if you look at that outcome, we're pretty close to an equilibrium. And so for me, as somebody who enjoys creative destruction, what I'm finding super compelling today is the starting seeds of decentralized finance on top of crypto networks. And I don't mean to talk about cryptocurrencies or tokens or assets. That's not what I'm saying. What I'm saying more is that they're now issuers of financial products, whether those are loans or whether those are investment companies or whether those are trading exchanges that are a lot like BitTorrent, that don't there's not like the one issuer. It's actually a peer-to-peer system that's not intermediated, right? So if you think about P2P lending and the promise of that, imagine that just in software on millions of computers. So what I'm seeing is fairly rapid development of decentralized finance Lego pieces. And the moment those guys realize they can take RoboAdvisor UI and just put it on top of what they do, I think is the moment when the Black Swan event happens, because there is no way to put that thing back into the bottle. So I'd say that's the 2019 theme I'm kind of most interested in as something that has the potential to be pretty wild.
Excellent. Well, extremely thought-provoking as always. Remind people where they can track down more of your work.
Check out next.autonomous.com for the newsletter. And then on Twitter is just going to be @Lex Sokolin. I look forward to you checking out the content and arguing with all of the things that I say.
Excellent. Lex Sokolin, thank you very much for joining us today.
Thanks for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter @Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.